I'm Martin King, property analyst at Edison, and I'm here today with Michael Morris, who is Chief Executive of Picton Property Income. Michael's going to talk about the first half results and the outlook. Good morning, Michael.
Morning, Martin.
Michael, you just reported those very strong first half results. Would you like to start by giving a brief overview?
Yes, so as you say, these are strong results. They reflect the 6-month period from March of this year through to September. Clearly that period is very different to last year when we were really in the sort of depths of the pandemic. And the results really, I suppose, show the business coming out the other side of, what's been quite a tricky, period. In terms of, what's happened, ultimately the underlying valuation of the portfolio has increased. The underlying income has increased. Rent collection is better than 12 months ago. Occupancy within the portfolio has improved as well. So lots of really positive metrics that show, the position for Picton, improving, quite significantly from 12 months ago.
Michael, industrial property, in which you're overweighted, has continued to drive the market performance, but returns have started to broaden out across sectors. Can you talk about market trends and how you're thinking about your own positioning?
Yes, so definitely the market overall is recovering, and clearly industrial continues to strengthen. Industrial values are higher than they were pre-pandemic. In the other two sectors, values are in offices slightly lower than they were pre-pandemic, and in retail quite significantly lower. And where we are now is a phase where retail that has taken a very big hit is starting to recover. But I would just add a note of caution that at the minute that's really only being seen in the retail warehouse or out of town sector, as it's known, high street shopping centres, of which we have a very small proportion. That's yet to really see a recovery. And offices still a little bit impacted from working from home. Not everyone is back in the office in a kind of normal way yet. Across the UK, for example, in Wales, there's still a requirement to work from home where you can, and that's still having a little bit of an impact. But generally, everything is lifting at the minute, as I said a minute ago. As we're in a more of a recovery phase.
And you are very heavily overweighted in industrial and very well weighted in retail warehouse. Are you starting to think that the portfolio positioning, should begin to change?
I think, we always review the portfolio and we have to make a judgment call for a diversified business where our allocation should be. We are still very positive about industrial, though. The combination of, good demand and low supply, I don't think is going to change dramatically. And, if you think about some of the issues we've had in the UK recently with supply chain, you can think about some of the, sustainability piece, bringing manufacturing a little bit more closer to home as well. I don't think that's going to change, but clearly price is an important factor in these things, and we will need to reflect on, where that is, in another 3, 6, 9 months' time. So we're happy for now, but that doesn't rule out changes in future.
With low gearing and available debt, you recently acquired a city centre industrial estate for 13 million. Could you talk a little bit about that acquisition and also what you may be thinking about future transactions?
Yes, so the industrial market is quite competitive to buy in at the minute, but this is a particular opportunity that we managed to secure in the summer. We like this because, as you mentioned, it's in the city centre. That in itself provides, I think, opportunities. It also has an element of waterfront with it. It's adjacent to the Gloucester Canal. There's a range of occupiers. It's slightly older units, but we've spoken to all the occupiers since we bought it. They're happy. And actually, there's some longer term redevelopment potential here. So buying buildings that have got future upside, I think, is quite interesting. And that was what attracted us to that property. In terms of what we're thinking about more generally, just because we've bought an industrial asset doesn't mean to say we're exclusively looking in that sector. And we've been looking quite closely at certain office properties where they have good fundamentals, and particularly where we think they'll be suitable in this kind of hopefully what I'm going to call a post-pandemic world. And selectively, even more selectively probably, in the retail sector. So there's a couple of retail warehouse opportunities that we've looked at, but ultimately we have to make a judgment call around opportunity versus price, and the fundamentals are best in the industrial sector. So we can be a little bit more risk on in that sector relative to the others, and we'll continue to look across sectors. And I think that's one of the benefits of where the portfolio is at the minute, that we can look across sectors.
Michael, quarterly dividends increased twice last year and again at the beginning of this year, yet they're still 121% covered in the first half. Can you talk about the outlook for profitability and dividends?
Yes. So in broad terms, we reduced the dividend the minute the pandemic hit, but as soon as we realised that the impact was not so severe on our business, we increased it again. The reality is, though, that the pandemic has gone on for longer than I think most people envisaged, back in March 2020. So, we've grown the dividend this year on the back of occupier retention, new lettings to new occupiers, and also on the back of our rent collection record. And I suppose really it's those three factors that are going to drive dividend growth as we look forward. There's one other element to that, and we touched on a minute ago our recent Gloucester acquisition. And there is an arbitrage between the cost of our sort of incremental debt versus property yields at the minute. And if you can buy good assets with a stable income stream, to hit returns that are ultimately accretive to dividend growth isn't that challenging when your cost of debt is sub 2%. So that's another variable factor in driving the dividend going forward. We've always said it's the right thing to do to run a covered dividend. And there's always the question, well, at what point is it covered? At 105% it's covered. Do you need any more headroom than that? And I think it's right that we've got extra headroom at the minute. There are still some challenges out there. The whole moratorium on rent arrears that the government imposed hasn't ended yet. We've got some increased costs running through the business for improvements to assets and some of the sustainability issues we're dealing with. So I think being prudent is the right thing. And if actually, as we go through the year, we feel we can, increase the dividend further, that's what we'll do. And that's how we're looking at it.
And that dividend cover, Michael, gives you the room to invest in the portfolio. In the first half, you invested, I think, 4.4 million, but you also showed the benefit in the first half in terms of the improvement in the attractiveness of properties to occupiers and an improvement in their ESG performance. Could you talk about that?
Yes, I mean, as a business, we're working very hard to get to a place next year where we have a clear pathway to becoming a net zero business. And as part of that, there is going to be a continued rolling refurbishment program, upgrading assets. Although that's a capital cost to the business, at the same time, it's going to increase the underlying attractiveness of these assets, especially as occupiers themselves are thinking about their own commitment to sustainability, some of which they'll do voluntarily, some of which are being, forced on the market through, either existing legislation or proposed legislation. So, we've always said, property is an asset that performs at its best if you invest back into it. Otherwise there's depreciation risk. And whereas, for retail, we've seen locational obsolescence because of, online. Now we're just having to contend with, ESG related obsolescence, and to invest back to mitigate that, actually, I think is an opportunity.
In addition to organic growth opportunities and potential further acquisitions, you've also spoken about being open to industry consolidation. Could you say a little bit more about that?
Yes, so I think, what we're thinking is just simply that there are quite a number of property vehicles currently that trade on quite big discounts to net asset value. And, we think, where there can be some degree of consolidation, ultimately for investors, that takes out duplication of costs. Plus there's economies of scale in the way you run the portfolio. So ultimately, consolidation is going to lead to larger vehicles, more liquidity in the underlying shares, and ultimately a lower cost base, which in turn, improves earnings and improves dividends. So that's our broad thinking. These things are never easy to engineer, and we're speaking about this in broad kind of aspirational terms, I suppose, on the back of the fact that we have really quite a narrow discount relative to very many of our peers. And also the fact, I think we have a pretty good track record, and I would like to think that people, shareholders, will be supportive of us being, a bigger business and have the opportunity to use our skill sets across a larger group of assets.